Good afternoon, everyone, and welcome back to KW Property Management and Consulting's Community Association's Best Practices webinar. I'm your host, Tim O'Keefe, an Executive Director and Partner with KW Property Management Consulting. Today is my favorite day of the year. Today is the day we get to focus on budget season. Budget season is fun for some, not fun for others, but many associations have already started to create their draft budget, while others may just be getting started. But we will talk about timing and the importance of getting moving on this year. We'll spend the next hour talking about budget process, insurance increases, how to handle the reserve laws, how to address surpluses and deficits, and much, much more. So get ready. The 2024 budget season is upon us, and there's a lot of options for what we need to do to get moving forward this year. We have two very knowledgeable and experienced accountants joining us today. Between these two ladies, they probably work on 500 to 1,000 budgets a year. And if you have any questions, our panelists will absolutely be able to answer your questions. So let me introduce them today. First, I want to start with Nicole Johnson-Pendergrass. Nicole is the Director of Operations for Hafer Certified Public Accountants. Hafer provides accounting, audits, tax, and financial management services for community associations. They have offices in Miami, Palm Beach, Naples, and Orlando. It seems that everyone knows Nicole, so she's likely a familiar face to many of you today. And so we really appreciate you joining us, and welcome back, Nicole.
Thank you so much. I feel honored to be a part of your broadcast today. Thank you.
Well, you know, we did this together 2 years ago. You might have believed it was 10 days ago, but it was actually in 2021, getting ready for the 2022 season. And I'll tell you that I never got so many great compliments from our audience. Of all the, I've done probably close to 100 webinars since COVID started. And the one we did 2 years ago together was the best response I got from anybody. So you all set the bar high. And the other person who set the bar high, I'll introduce now, is Roxana Dorigo, another familiar face on my webinars. Roxana is an Executive Director and Partner with KW Property Management. Roxana is a CPA that oversees all of our back office accounting services throughout the KW system. Roxana is always kind enough to join me this time of year and provide updates on best practices for creating association budgets. And boy, do we ever have a lot of changes this year. So Roxana, welcome back.
Thank you. Thank you for inviting me. My favorite topic, budgets. Yeah. Thank you.
So I'm going to ask both you ladies just a general question to start with. So there's always, a few tweaks every year of things that need to get done. And a couple of years ago, we talked about some changes. But do you ever remember a year having such significant changes as what we're going into addressing 2024 budgets and beyond?
So I thought 2008 and 2009 was a dangerous year with all the foreclosures and everything going on. This is not even comparable. With everything changing in the new law, with all the insurance increases, I have never seen in the last 3 years the amount of increases in maintenance fees that these associations are going through, especially in condo world. So I feel it's very unique. And I think every condo board, HOA board really needs to do these webinars to get understanding of. They can't say we need to keep the maintenance fees the same. They need to start looking as truly like the business and where these funds need to go for the increases and start educating the owners.
Yeah, I agree with you that I entered into the industry in 2008, and that was all about bad debt and talking about collections. And it was hard. It was going to the board and understanding why we have this bad debt line. And although there was a lot of discussion, it was probably to a select group, pretty much the board. Now, what I see is a lot more interested parties. And that's what I've seen a big change in. Obviously, the increases are affecting our owner finances, right? So they're paying a little more attention because there are not the normal, maybe 3 to 5% increase based on inflation that we used to see for many, many years after that bad debt time frame. Then we kind of went into a very silent cookie cutter for the most part, 3% to 5% increase. And now since 2021, 22, we're seeing double-digit increases across the board. So there's a lot more conversation. There's a lot more questions from the owners. And so, yes, I've never seen it like this. Like in the past, year and a half.
And Roxana, to your point on board member engagement and owner participation, I've never had so many questions sent to me prior to a webinar as this one. We got dozens of questions. So I'm going to do our very best to get through as many as we can. But during the course of this session, for those listening, you can look at the bottom of your screen. There's a Q&A chat line. You can send your questions to the Q&A, and we'll do our very best to cover those questions. But we've got your 40 other questions that already came in. A lot of them are very similar in nature, so I'll call out and be very specific about some. Others, I think your questions get answered along the way. So hang in with us and follow the bouncing ball as we get started here today. I'm going to start with kind of the easy stuff. So Roxana, if I could start with you and talk about just the general budget process that we have, because we always had picked a month when we started in the past, and you've changed that because of some of these new requirements. So talk a little bit about our process at KW when we started this year versus in the past, and then touch a little bit on a couple of questions that came in, like Kurt in Winter Haven said he wants to know what a budget process is for a larger management company. So talk about that. And Elizabeth and Stuart was asking, what's the role of the property manager in creating the budget? So if we could address all those, and Nicole, I want you to jump in and help with those questions too. But let's start with what's the process?
Yeah, so every year at the end of a budget season, right in December, we meet with the operational team and accounting comes together and we talk about the budget season. Like, what can we have done better? And across the board, everyone in that room, operational people, accounting leaders, all said the same thing. We have to start earlier. We need to start in April.
When did we start before?
I'm sorry. We already started what I thought was early, which was end of July. We now moved it to April.
And you're talking about for properties with a fiscal year end of December 31.
Correct. So we had literally just finished a budget season for some of our boards that because of insurance quotes, delays, or, some of them actually approved a little bit later in the year, waiting for those quotes. So we literally just had finished the budget season and we're opening 2024 budget season in April. So for us, where it starts is education. We need to start talking about industry concerns, industry effects on the next year's budget. So insurance is a big topic. We go to our managers in April to talk about what are we seeing in the industry, how is it going to affect our budgets? And what we did differently this year is we approached the budget season with mini goals. So after April, that was the kickoff. Different accounting leaders go throughout the state of Florida to our different areas and offices. And we kicked off the budget season with the mini goals. So starting in May, we broke down the budget by sections. There's certain things that we could do in May based on historical data, such as administrative fees. So if you're looking at the administrative fees, legal fees, a bad debt, financial condition of the association, where do we see this association in 2024? We could actually start putting in data for that. Postage, does it change a lot? Maybe not, a little bit, increases here and there. So we started breaking down the budget into sections and started in May. But the real intent and goal is to allow the owners that are questioning the increases. Now we're expanding the number of meetings we're having. So we wanted to give time to that so that come July, we can have a budget workshop and start involving the community to ask their questions. And at the same time, we're now calling in more professionals. We're calling in the insurance agent to meetings, to a town hall meetings. I've been to at least 8 in the last since we started. Just hearing the insurance professionals talk about what's happening in the industry and address the concerns of the owners. now we need to give them time to voice their concerns, right? And address them and be as transparent as possible for them. But that takes time. So we needed to give that into the timeline of our budget. So we started with budget workshops in July. They called in accounting in some cases to talk about where's the financial condition of this association with the same concerns. If my fee is going up, how are we doing as a company, as an association? What is happening with our reserves, et cetera? So that is happening now. Our ultimate goal is to approve the budget by October 15th. And the reason why our goal internally and for our associations is that we would like to have all of the budgets and notify all owners of the changes that are coming for the following year. So by November 1st, our intent is to communicate that with the approved budgets so that as an owner, you can adjust your potentially your financial condition and your own personal finances. And there would be no more guessing game. You have 60 days to really adjust. And then we also don't want to get into the holiday season where potentially, they're taking vacations, they're not really in tune to what may be happening or notifications and meetings that are happening at the association. So we're also addressing the reserves for our condominiums that now have to do the structural integrity reserve study, allowing time to hire. Our goal was to hire that person by May of this year. That was part of
at that point, Roxana, there's just a lot of education that you talked about earlier that really gets wrapped around the reserve side of things. And we'll probably spend most of this discussion talking about reserves. But from your perspective, Nicole, are you seeing a general push to start earlier, or is this just like kind of one of the things that we believe is the best practice for us? Because, we take budgeting very seriously. KW is a company founded by CPAs. There's 11 of us that are partners, 5 are CPAs. We have about 15 CPAs in the company. So we love budgeting, right?
Oh,
so is that just a general, a general rule that you're seeing that's good to start early?
Well, that's why we love KW. Highly impressed by what I just heard of how you guys work the budget process, because more associations need to do that. What we're seeing is that when the new law came out and then the glitch bill came out, everybody was in a scurry that, how are we going to do this? What are we going to get planned? But there was no organization. And what I found very troublesome to a lot of communities is they weren't ready to educate the owner. So a lot of times, if you've seen in audit reports, that was in there last year, this new bill. And there would be board members coming back to us saying, don't put that in the audit report. We don't want to scare the owners yet. And what I'd like to hear from Roxana is she is educating the owners. She is getting them involved, because that is what you need to do. You need to be transparent. Why the increases? What's happening with the reserves? So I think more and more boards need to hear this, because April is a great starting point. If they're starting in July and August, they're too late. The owners now don't have enough time to understand what's going on. Why are we getting increases? Do they have time to get the insurance agent out? So what your process is what should be happening in the industry, especially with so many changes taking place.
Because we're talking about, if we start on April 1 and we try to get finished by the 16th of October, that's 6.5 months. And that gives us a little bit of wiggle room, maybe 30 days of wiggle room to make sure it's done by ideally November 1st, but it gives us still maybe the 15th of November to finalize everything. That's a 7-month process, right? So, and we're doing several hundred budgets, but it's you still have to do it the right way, and the education piece is important, because we know board members have lives. They're not getting paid to do this, and we're trying to find their time and have the right amount of time to educate and to hold budget workshops. It just, scheduling is part of the time factor that we have to consider when we put these together. So it is important to make sure that you allow enough time for.
And I think some unit owners forget to realize too, and I always try to say this when I go to budget meetings, I don't do budgets because I audit the association, but remember, your board members are paying these dues also. So they're trying to do the best they can to keep those maintenance fees where they're paying it also. I think people forget to realize that just because they're running the community, they're still paying those dues also.
Well, all those people that are complaining on the other side of the table, put them behind that table as a board member. They have to make the same decisions. Exactly. The decisions have to be in the best interest of the community, fiduciary responsibility, make sure you're budgeting effectively. So most everybody on this call is board members. So I applaud you for all the effort that you do and for the bullets that you have to take from time to time, but we're here to support you.
Yeah, I think this time as a board member, it's very hard. It's difficult. It's not, there's an added pressure that I don't think existed necessarily before the changes in the statute with the reserves, and definitely because of the increases in the budget. So
I agree.
Jackie's asking the question, how do you have the budget ready when insurance is renewed in November? It's like, well, you have to have a process. So the process includes call your insurance agent, ask them what to expect. What are you seeing, Mr. Insurance or Miss Insurance Agent? If they're seeing that insurance is going up 30 or 40% in the market that you're in, and you probably had a big increase last year, if you had a 100% increase last year, maybe you'll get a 25 to 30% increase this year. Budget for that. And that's the way you do it. It's not going to be perfect. It's a budget. It isn't a perfect budget. So,
right. And something to add to that is that, yes, there's a concern with the particular association not renewing, and we could call in the agent and the agent's going to give us a ballpark. But we're also, as a management company, we also can go to all insurances and let us know what they think, right? Not just your insurance company, but just the ones that are in the industry, and see if we can align with that percentage, right? So that way we can say, well, what we're hearing in the industry from these professionals that work in this industry, this is the average. And pretty much what I'm hearing from the insurance agents, they're very much aligned with the increases for next year.
And I have some associations, it's a pretty good idea, is that they'll talk to other associations that have different insurance like cutoff. So they'll talk to their neighbor, maybe that's cutting off in June, and saying, what was your increase?
Right.
So they get an idea of, okay, well, ours is coming up in a few months. Maybe we'll be close to that, but they're budgeting close. So they look at what other cutoffs are.
And Jackie, I don't know if you're self-managed or you work with a management company, but I would suggest have your manager reach out to neighbors or there are other associations that that management company could manage. Just as Nicole said, you can get some great input, and you should be able to build a budget that's pretty darn close. If you're off by 1% or 2%, one way or the other, shouldn't be material, but you'll be able to get close. And that's what the budget's supposed to be for. And then Beth was asking, who are the best people to include in a budget workshop, Nicole? Or I'll send that to Roxana, since you go through a bunch of budget workshops.
Yeah. So in our world, we do include all of our departments. We do input into the budget recruiting team. The recruiting team does a market analysis for payroll. What are we seeing in the industry? What is the average rates that we're seeing for all different departments, all different positions? We definitely call in the accountants. So the accounting team lead would go and be available to a budget workshop. And also, of course, the operational team, which includes the manager, the district manager, and each of us bring a different strength. The accountant lead is going to be there to address the financial condition of the association. How are we doing with bad debt? What is the recommendation? How are we doing to operating surplus or operating deficit? What do we have to include for that, or what's our recommendation for that? And of course, the operational team with their knowledge of the association, the repair and maintenance or contracts. And then also the district manager can bring in what we're seeing with the utility companies, for example. What are the increases that we should expect in utilities? So all of us have a strength and input to the budget workshop, and we're inviting all owners. The budget workshop, from just running the actual meeting, it is there for the owners, right? The board is there to discuss the budget, but then they open it up for discussion, to talk about the increase, to talk about the different areas like insurance. And we have often, just recently, because of, the increases being driven by 3 key components, one of which is insurance, we do call in the insurance agent as well to the budget workshops.
So a question that came in was about budget workshops, basically, and like what kind of notice needs to be put out? What's the public notice that needs to be made for public workshops? It doesn't need to be made, or is it just the budget committee's final meeting needs to have, where they vote, needs to have an open meeting? So how's that work?
So 2-day notice is adequate for a budget workshop.
Okay.
However, I would say this: you need to promote it. You want to go out there and really give a voice to the owner when they're available. So it depends on your demographics of your building. If they are, if your document even allows for after hours to allow more people to go, that's when you should do it. And promote it. I think 2 days is great because that's, compliant. But other than that, I think giving it a little bit of time to really alert people, hey, we're having a budget workshop in 2 weeks, for example. And part of the mini goals that we established in our budget process this year was that exactly, to put it on the calendar starting in May. One of the goals in May was to put the budget workshops on the calendar so that we can work towards that and also work towards the promotion of coming to those budget workshops.
And I think it's a great suggestion you made, Roxana, about budget workshops are for the community so owners can hear, because so often we hear, and I'm sure you hear this from customers too, Nicole, that the owners don't know what's going on. There's got to be more transparency, and the board's approving expense for everybody. So why not include everybody in these discussions? Now, it might open up more windows for people that like to complain, but the reality is it affects everybody the same way. Everybody pays virtually the same amount, unless you have a budget that's based on the size of your apartment. Then it might be a little bit different, but give everybody an opportunity to understand, educate the entire community. That's really a best practice. And this is all about best practices.
And it is good to include people, but one thing I always try to say too is sometimes including too many people. I have some associations that have huge budget committees and they can't get anything accomplished. So that can be a nightmare too. So I always say it's good to have the input, but like Roxana said, bring in people from the management company side that have the experience, and then you can have the input of the owners, but too much input, sometimes nothing ever gets done and accomplished.
Bring in Roxana. She knows how to manage these things.
Yes, exactly.
Yeah, true. I've been in those meetings, and it is the management's role to kind of bring it back to the purpose of the meeting, to allow owners to have a voice. But something that I think works really nice in those budget workshops is a sign-up sheet. So if you want to speak, please give us your name, your unit, and everybody has time to speak equally.
Right.
So, Roxana, one question that was asked from Kurt was, Elizabeth asked this question: what's the role of the property manager in preparing the budget?
So our property manager does take the lead in the knowledge of the association. So they're there to really witness, how are we going to protect the value there in the association? How do we preserve what the association and who purchased here, what are the elements that they purchased here for? And how can we enhance the value of the community? But they are also, and this stayed with me, I am a CAM licensed person, and this stayed with me when I was going through the course, is that the manager is not an expert in everything, but they better have a Rolodex of the experts to call in. So with a management company, you have them all accessible. You call in your district managers for some benchmarking, for some best practices in the area or particular to that association. You call the accountant, they come in. So we all have our strengths. And the manager's role is to complete the estimated budget. An accountant, though, comes in and gives a recommendation for bad debt and for financial condition. The manager and the district manager then work together to look at utilities. They look at all the different areas: administrative fees, legal fees, engineering, contracts, making sure that that's all aligned, that we have accessibility. In our world, everything is electronic, so we're sharing those documents, but they're also aligned and ready for any questions in these budget workshops. To have that contract ready, we have a contract summary, so the manager's completing that. The repair and maintenance, the manager's bringing in our chief engineer or our maintenance supervisor to get a review of where they think repair and maintenance is. That's definitely an area I'm not an expert on, but something that we did a big push starting last year is to bring in those professionals that are already working for your community potentially, right? They know best about repair and maintenance and what's happening with the association in that regard. So the manager is completing the estimated numbers on the budget, and the accountant is calculating one item, which is the reserves. So that is where accountants in KW do contribute to the calculation of the reserves.
Well, at least in our world, the managers get a whole lot of support and a lot of effort, and the process is kind of overseen for them, so that holds them accountable to staying on task to certain dates, which is important. So a question came up, Nicole, and I want to ask you this because this is a budget, this is a balance sheet question, so we don't get these. But Elizabeth in Bradenton was asking, so what if you get to the end of the year and the prior year's equity, there's prior year's equity, how can it be used going into the following year?
So that's a great question. So equity, so everybody has an understanding, is if you took the income statement in an association every year and their surplus or deficit rolls into the equity. So if you have a positive equity position, that means you've had more surpluses than deficits. But you really want to look at, there's many different ways to look at this. First, are you fully funding reserves? First thing you need to look at, are you funding the capital items in your association? If you're fully funding, then you can look at that equity and say, do we have 2 to 3 months worth of operating in the equity? If we do, anything over and above that, we could potentially use to offset next year's budget, put it into reserves for future capital, or leave it in our equity. I always kind of hesitate to let anyone say to apply it to the next year budget. The reason I say that is when you're applying it to the next year budget, you're really putting in people's minds, if you're keeping it the same, the maintenance, when it increases now that you have no more equity, they're all going to say, why are we having a huge increase? So I always say, move it into a reserve for capital or leave it in equity for future projects, because it's still going to the owners. You're still giving it to the owners, but you're giving it into effect for operating future items or reserves. Because a lot of associations, one of the biggest deficiencies in a budget for me that I see is the contingency line item. They never have anything for backup. Even when they're funding the reserves, they need a roof repair. Well, they don't have it in operating, but it's really not a capital reserve because it's not for the replacement. So if that equity is in a good position, you have that for things that come up as an emergency situation. So that's how you really need to look at that equity section. It's really for financial stability too. When people buy into your community, do they have low AR? Do they have good equity? And are they funding reserves? They're the key points they're looking at in a financial statement.
So is equity the same as the surplus?
Yes. So surplus rolls into the equity and then it rolls for future.
And is it taxable?
So that's a great question. That's kind of like the big elephant in the room. So it depends on what tax return they file. So if they're strictly a simple association that has all the dues that come, all the maintenance fees that come from the owners, and they're filing an 1120H, homeowners association tax return, most of their income is exempt, meaning that is not taxable under section 528 of the IRS code. So that equity would not be taxable. If they fall out of filing the 1120H and have to file an 1120, a regular corporate return with the Florida return, that surplus is potentially taxable. Now, there is an ability you would have to elect before year end to roll that surplus into next year, which you have to go through all the hoops of what the IRS requires. And you actually have to show it on your budget the next year that you rolled it forward to make it not taxable. And one of the questions in the whole CPA world, and I know that Roxana has been involved in this year and she's teaching this year, which we're so happy to have her, is that how many years can you keep rolling that forward? There's going to come to a point that the IRS is going to question that and saying, you're really having all these surpluses. Do you need to pay tax on that? So it is something that has been talked about for years. How long can you continue to roll that forward?
Yeah. And I think one of the key things that you said, which I love, is that retain 2 months of operating expenses in that equity and protect it, especially now. There's a lot of unforeseen, just in even not, let's just say even before now, there were unforeseen expenses because we're a hurricane prone state. And just having gone through that with our properties because of Hurricane Ian, the properties that were able to respond and clean up common areas fastest were the ones that said, not a problem, here we are. This is why we were saving this money for these type of occurrences, and we have no problem to pay and get our community cleaned up and back to normal. And there was no need to go back as an emergency to the owner as a special assessment or to have an emergency line of credit incurring interest. So it's definitely a recommendation we have. We don't talk about surplus unless it's over and above 2 months of operating expenses. And if you do have that, great point, roll it into reserves. So, yeah.
Okay, well, you ladies keep talking about this 4-letter word called reserves. And so let's get into that a little bit. Nicole, can you describe, let's start with what is a reserve and the difference between pooled versus straight line, and then we'll get into the laws and how that all changes things.
Sure. So reserves is, I guess, the hot topic for every association that should we fund, shouldn't we fund? Well, new laws coming in place that's not going to be able to happen anymore. Reserves are used for things that are capital in your association that have over a year life. So for example, your roof, painting, paving, your pool, anything that is long-term that's considered capital. You're saving for that over a period of time, so you potentially don't have a special assessment. So in the state of Florida, many years ago, they allowed you to add something in called a pooled reserve. So the component and the pooled are two different types of way to fund these reserves. The pooled method is really the cash flow method. So the component I'll explain first, it's kind of the easiest to understand. You have all of your line items, painting, paving, roofing, and you have each line item that has an estimated life on it. And then you have an estimated cost. And remember, they're estimates. They're not actuals. You might come in next year, have a reserve study, and next year inflation brought it up to a higher price. But you're going to take that and you're going to divide it over the life of the asset, and it will give you a yearly funding for that item. When you fund that item, it goes into the line item like roof, and that can only be used for that line item, unless there's a membership vote that moves money from one line item to another. But they are supposed to be restricted for each line item. You only use that money for that line item. In the pooling method, when they instituted this and allowed it, which a lot of people have moved to the method, if you want to move from the component to the pooling, it does require a one-time membership vote to move from the component to pooling. The pooling is taking it and allowing you to have all of them into one pool. So all of the money is in one pool, and you can use it for any line item that's in reserves, and it does not require a membership vote. But the pooling schedule, the state is very strict on how it is calculated. And a lot of my properties don't calculate it correctly. So for example, we'll take painting. Painting needs to be done every 7 years. In your pooling schedule, you should have the cash year 7, year 14, year 21. And what happens is a lot of boards put this together and they'll put the painting expense in year 7 and you'll never see it again. So that means the funding is not correct. And they'll come back to me and say, well, our funding's less in pooling. It's less because you're not doing it correctly. So it should be when that cash is needed, you have the money when it comes due. And we actually have templates that we put together. And I know KW, you guys do a good job on the budgets. You guys have never been written up in the audit because you do it right. Is that it needs to go over a 20 or 30 year period, the longest life in your asset. So if your roof is the longest, it goes out that schedule over the 20 or 30 years.
And
go ahead.
Something that I want to mention is that it was prior to COVID. So it was around 2018, 2019, where many of our associations did go to the pooling method. And with that, you do have to have, it's not a free for all. Like, I think there's a misconception, like you could just go for anything.
Exactly.
And that there's certain defined things that have to be in the pooling. And what it is you always bring it back to the reserve study. Because one, it's a document that was given to you by a reserve study specialist that also allows the board to point to, this is where we got our information. It's the best information with a party or a specialist that has a tap into the industry and what's happening in our community and how increases are happening in replacement costs for roof, for paving, for painting, etc. And so what we do is we replicate the pooling or the straight line from the reserves into our budget template. Because when the reserve study is issued, it's a moment in time. And when you've read through the 120 pages that could possibly be there in the beginning, they give you the assumptions that they've made. They've made assumptions for the association that all of these projects, and sometimes I look at the list for 1 year and I'm like, that's 20 projects. How are they going to accomplish 20 projects? What's reality? That changes. Those assumptions change over time. So we have to replicate it in order to adjust those assumptions. And that's okay, because sometimes you may have more projected reserve money because the existing year or the current year's projects weren't done, but they were done for a good reason, time. That you can't accomplish the 20 projects in 1 year. You need to space it out, and maybe they did the right thing. They voted them all in, but it actually fell into the next year. And how do you address that in the pooling? The only way is that you have to replicate what was in the reserve study. So we definitely used a reserve study. All the numbers start there, but when assumptions change by line, we're making the change and also saying why there was a change. So that keeps with the records of the association.
And I think a lot of people have a misperception too, and it's a great point, Roxana, is that when this pooling schedule is put together, year 7, they have to do the painting. That's just an estimate. You might come to year 7 and we don't need to do the painting yet. And now it can go out to year 10. So it's just an estimate of when you anticipate doing those expenses. If they're not ready, it doesn't mean that you have to spend them.
And so Nicole, Christina's asking, is pooling by line item?
So pooling is not a line item. Pooling is all in one pocket, but it's listed out. So you still have to have a list of all your reserve components, but now it can be used for any of the components, all the cash that is available.
So you budget it by line item based on how much the expected amount of money you're going to need for that particular project, but you can use those funds for other projects because it's in the pool.
Right. It can be used for any of those line items in the reserves in cash.
Okay. I'm going to clean up a couple other questions that had come in. If I don't give the right answer, just act like I did so we can keep moving along. But somebody asked a question, can the budget committee meet preliminarily in private before an open meeting with the owners? Absolutely. You can do that stuff, but when it gets serious and you start sharing real information, bring on the owners so that they know what's going on, but you have to get organized and have a plan, and it's okay to do that privately. Someone asking, I'll throw this to you, Nicole, can you have a contingency line item in the budget?
So in operating side, absolutely. There should be a contingency. Basically, that is for emergency situations. You should always have that. In reserves, no. There's no such thing as contingency in the reserve budget part.
Yeah, the statute, I know it's pre-COVID, but they did clarify that not to have general reserves. In years past, we used to have general reserves and it was a catch-all. And they clarify that in the statute that you can't have that. You have to have specific components and address those specific components in the pooling or straight line. And for me, from a contingency line, if you have it in your budget, don't make it a material number. So Sometimes we've inherited an association and we start managing it, and we look at the budget and we're reviewing the contingency line, and it's $100,000. And we're like, okay, that's 10% of this particular budget. We don't want that, because we want to really define where are the funds going. One, for transparency to the owner, and two, to really be able to measure if there's a plumbing issue, call it a plumbing issue. If historically you've been spending $50,000 on plumbing, one, there might be an issue there that we need to address, right? Look at. But how do you measure that if you keep on coding things to contingency? You need to undo that contingency at the end of the year, because it's a misconstrued amount. There could be things coded there that are repair and maintenance, but also administrative costs I've seen misclassified into contingencies. Well, it's just because it didn't meet the budget, so it immediately went into contingency. So I would limit the amount, have something, but not a material amount.
And I agree with you, because I think the owners too, they want transparency, and it's not a slush fund. I really always say it's really for an emergency situations, that if something comes up you didn't anticipate. But if you know your plumbing and all that, it should be coded to those line items and not just as a catch-all and like a slush fund, because people start questioning that and saying the board just has a free-for-all and spending it anywhere when they have such a large contingency.
Okay, so I'm going to let's start talking about the reserves a little bit deeper. So Nicole, I'll let you talk about this. You just came out of a class, but that was addressing reserves. So talk about the new law, the new reserve law, and try to clean up and clarify for all of our listeners today what it means to be fully funded by 12/31/24, so December 31st, going into 2025. What does that actually look like? What does it mean? And the impact that the CSRS new law has on this whole concept going forward.
So the fund CSRS, it's been quite an interesting 6 months of what people have to do.
Hang on a second, but
yes.
let me clarify. We're talking about CSRS like everybody knows what we're talking about.
Yeah.
So please clarify what CSRS stands for and why we're talking about it.
Exactly. That's the Structural Integrity Reserve Studies. So these are the new law that's required under 718. So if you're with 720, this does not apply to you. This is all condo law. And the glitch bill that came out in May and has been passed, there's been some changes, but clarifying more of what has to take place. So I think we have more of an understanding from a management standpoint, accounting, reserve studies of what needs to take place. So the first thing is anybody that is applying to that 3 stories and higher needs to make sure that they've contracted now with people to do their milestone inspections and to do their SEERs, the structural engineering report. Very important that you're reaching out now. Many of the companies are booked out a year and a half. They're required to be done and have them by December 31st, 2024. So it's so important that you're getting that, because that's going to be the basis of all of where the funding is going to go, where you're going to be at, how much you're going to have to fund. And in the glitch bill, they did put, and they clarified that if your budget is adopted on or after 12/31/2024 is when this takes place. So if your 25 budget is approved before that date, the actual fully funding won't be required till the 2026 budget. So you want to make sure you understand that in that sense. We're telling our associations to start it now. The most important is to get it, let the owners know about it, and know where your funding is. So once this structural engineering report comes back, they're going to determine where your reserves are now currently and what you have to do in order to come up to this fully funding. So it's fully funding that is required, not fully funded. So a lot of people got scared when this came out and said, we're going to have $6 million by 2024. No. So it's all based on this study. So if you're funding reserves now and you're getting all your work done, you might not have a huge impact, because you're fully funded for the year might not be that have much of an impact on you. So this study is the most important. So fully funding is having the amount in that line item when that asset comes due to be done. So let's take roof, for example. Let's say you're funding the roof at $100,000 and you have $300,000 in it, and there's 3 years left. You could be fully funding. You now have to fund the remaining $700,000 over a 3-year period. So that's what fully funding means, is by the time that is ready to be done, you have the cash. So people that haven't funded reserves, when they get the study back, there's going to be a few options. And I do encourage people to take some of these reserve studies courses because they're very interesting. There's a few ways to get to this fully funding. There's baseline method. There's the fully funding method. There's the statutory method. So there are different ways to get to that fully funding based on the cash that's in there. I think one of the most complex issues that's been out there lately is everybody now that is funding reserves has the non-structural reserves. So they have the painting, paving, roofing, pool, elevators. Now, the structural ones are required to be fully funded. The other ones can still be waived and partially funded based on the unit owner vote. And now that's also changed. That requires the majority of the ownership to waive or partially fund them.
Okay,
so you're going to have
let me ask you this question. Then
go right ahead.
You're talking about this because we oftentimes hear you have to be funding for paragraph G. So that's part of Senate Bill 154. So explain what paragraph G is for everybody so that we can clarify that and then you can move on from there.
Yes. So in paragraph G, they list out the actual components that are required to be in the structural. For example, there's roof, waterproofing. There's a whole list of, and they got changed. So the bill last year and this year, the components in that G are different. So I would definitely get a list of those so you know what's in there. The people that are doing the studies will know that also. They're required, those listed in number G, those components are required to be fully funded in 2026 budget. You are not allowed to waive or partially fund them, and never can the membership vote to use them for its unintended purpose. So in the past, reserves could get a membership vote and use it for something else. These new structural components are not allowed to be used that way. They must be set aside for those. So now on the accounting side, you're going to have two sets of reserves. You're going to have the non-structural reserves, and then you're going to have the required structural reserves. What's been brought up is, and this is going to be a lot of the things that boards are going to have to work with the reserve companies. We have money in these non-structural reserves, and some of those reserves are the new structural. Roof is an example, because roof is in the old reserves and it's in the new structural. So if you're in the pooling method of the non-structural reserves and you want to move money to the new required structural reserve, you're going to have to sit down with your reserve companies and come up with some type of allocation of what money is going to move from the old reserve to the new reserve. Because in the pooling method, it doesn't give you a breakout where all those monies are. If you're in component, it will be very easy. You know, you have 100,000 in roof and you can move that over. So the pooling will be a little more complex. The reserve companies are aware of this and they're coming up with some type of allocation to do that. But the old reserves can be still voted on. The new reserves, the structural, have to be fully funded. So when you get that report from your company, they're going to give you those options of the different types of funding. It's still going to be required to be fully funded. So that means when those assets come due is when you have to have the money for that to do the projects. So it's been very complex in the sense I did a class this morning and I had some visuals. I set up different money bags so people can understand how money can move from one to the other. I wish I had them here. It's hard to do on Zoom, but it gives you an understanding of what the old reserves look like and what the new ones. But everybody's going to have two sets of reserves. And the new ones you will not be able to use for anything but the structural.
Yeah, something we changed in the way that we do budgets and the budget template that we produce for the owners is the reserve schedule. So we literally started since the end of 2022 for the 2023 year. We defined and separated within even the pooling, the structural versus the non-structural, or what we're calling other components. So that visually owners started to get familiar with this new statute, aligning ourselves with how the statute read then. Now there's been a clarification in May of 2023, which took away certain components I think we were all a little bit confused about, like foundation was taken away, and also they added exterior doors, which makes sense. So they had windows, which is still a controversial component in itself, like isn't the owner responsible or is it the association? So there's a little bit of that still, but they added exterior doors. So our new schedule for 2024 will still make that distinction of structural components and other components, but now we're going to change it in line with the clarification.
Nicole, I think you just did a great job explaining that process for reserves. So for those of you listening today, don't feel like you have to memorize it. If you're listening, we're going to email everybody a recorded session tomorrow. So you can go back and re-listen to this session and start listening at about 50 minutes in, about 45 minutes in, you'll catch all of this, okay? If you want to fast forward, but everything we're talking about today is very relevant and terrific information. We only have 9 minutes left, so we're not going to cover half of what we intended to today. So I'm going to put you ladies on the spot and say, would you be willing to come back next week and do this again quickly? Because I want to keep the momentum going forward. So think about that. We got 9 minutes to answer that. But I just want you to know that you've got about 110 of your best friends listening right now. So if you can answer it now, you can, but we'll address that. But this is such an important time of year, an important topic that I want to make sure we keep this, keep the momentum moving forward, because we're just hitting the tip of the iceberg on some of these items. Question from Mark. These issues that we're talking about relative to CSRS, this doesn't affect HOAs, right? This is just a condo issue.
So condos and co-ops, right?
Correct. Yes. So it's not, Mark, it does not affect HOAs. And then Connie was asking, is there a certain dollar amount for replacements that would be required for like non-CSRS things like flagpoles, basketball hoops, things like that?
So yeah, go ahead, Roxana.
Well, I was just going to say the definition you gave still holds true. All that the new statute did, as I see it, is just a definition of structural and then defining some components that we haven't seen before in reserve studies. But the definition of what you said earlier, Nicole, any replacement of a capital asset that has a life greater than or a deferred maintenance greater than a year and $10,000 should be a component. So there will still be, outside of the structural components, there will still be the elevators. There will still be the lobby renovations, because collectively a lobby, although maybe individually the curtain doesn't cost $10,000, but collectively the lobby remodeling does cost over $10,000. That would still be there. And other things like pool, right? I think we were talking before the webinar and we're like, yeah, what about the pool? Right? That still exists. That's still a reserve component as defined by the Florida statutes.
So Christina is a new board member and a treasurer, and she's asking, can reserves be thought about like capital? So, something that has greater than a 12-month life really isn't most reserves that are, it's over $10,000 items have most of the useful life is probably 10 to 30 years on most of those items. So it's certainly a longer life than a year when we're talking about the reserves. So I don't know if you guys have any comments on that, but.
No, I agree with her. It's thinking out like it's capital. So anything that's capital in your neighborhood, even if like your gym equipment, your pool furniture, they're capital. They're going to last, 8, 10 years. The only item that isn't, that a lot of people question and they'll say, well, it lasts more than a year, is landscaping. Landscaping is not considered capital under statutes. So a lot of people don't have a reserve for landscaping, but everything else that you walk around your building that lasts more than a year is capital that you would want to reserve for, because that's what reserves are there for.
Elizabeth is asking, where can we find G items? So.
Sure. It's under the new glitch bill. If someone emails me, or if you even reach out to your attorneys, they have all of the information on G, paragraph G for the new glitch bill of all the listed items.
Gerard's asking a really good question. He says, we just replaced our roofs this year. Do we still need to be funding for roofing or just for maintenance? Do we need to be funding for new roofs or just the maintenance of it now going forward?
Yes.
So yes.
In unison.
Exactly.
Yeah, because as soon as that's done, that life, the useful life of that roof starts to depreciate, right?
Exactly.
So you're gonna reach a point where 25 years out, you have to replace that roof again. But on day one, once the project's done, it starts to hit its useful life, and you got to start tracking for it.
Exactly, because you're going to have to redo it in 20 years. So you need to fund it 1/20th next year, and then every year forward till it comes due again.
And Robert's got an interesting point. He said, $10,000 reserves was from 1992. Shouldn't that be $25,000?
Yes, I agree with Robert. When I said it, I was thinking like, yeah, we never adjusted to 10,000. What's the 10,000? That's all.
They've never changed it, and no one knows where it came from originally.
Yeah. 10,000 doesn't get you to the corner.
So Nicole, let me ask you this question, and I think this may be our last question of the day on reserves, and then we'll come back and hit this again. But there's been some confusion about, can SERS funding does it have to be straight line, or can it be pooled? Is there clarification on that? Because some people, at first it wasn't addressed, and now I think it's been clarified. So just to clean that up, if you don't mind.
So it's actually been clarified, correct? They came out and they put wording in that, yes, the SEERS can be pooled, but it's still only for those components in the SEERS, but it is allowed to be pooled.
Okay, very good.
I think that was a great clarification, but also a win, right, for the association.
Yes, I was grateful that, because it was confusing. They never addressed that in the beginning, and everybody said, well, they're not going to be able to. And we were like, well, if they're only using it for structural, what's the problem? As long as they can't use it for something else.
Yeah, and at the beginning, the ones that were affected immediately were the developers. So the developers now needed to do the structural integrity reserve study the fastest than any other condominiums or type, and they were getting because we do deal with a lot of developer. One of our core businesses is to do consulting for building up an association from scratch, and the attorney recommendation to the developer was to do it straight line. So they did receive some opinions from attorneys early when the law passed to do the structural integrity reserve study on the straight line method. Interesting. I did not know that.
So Roxana, we got time for this, my question, which is, do the reserves, so when you're funding for reserves, Patty was asking, do you fund for unknown things like pipes breaking? So clarify what a reserve issue is versus repairs and maintenance.
So that sounds like a repair maintenance where there's an unforeseen pipe breaking. You're not replacing the full, in the case of pipes, the full infrastructure of the pipes, the plumbing, which is now a structural integrity reserve component. But if there is like a roof, I think a lot of the examples or questions that come to us is roof related, which is a little bit easier to define. If I'm going to replace a patch of the roof, can I use the reserves? And the answer is no. The reserve component is meant to replace the full reserve, the full roof, not patchwork. I don't know if that helps, but I think what she was asking was if there was a pipe that broke in the ground, if that would be a reserve component, and the answer is no, that would be operational.
Okay.
Expense.
So not a best practice, but just a question. Can an association still waive reserves in the 2024 budget? Because I know we saw owners that are boards that waive reserves in 2023. May not be recommended because it's just going to be more funding down the road, but can you legally waive reserves for your 2024 budget?
So from an accounting perspective, yes, they're still allowed to waive it because probably they haven't had their Sears report or milestone, but it's not required if a budget on or after adopted 12/31/2024. So they're still able to waive that and partially fund it by the membership.
Does it take a membership vote to waive any or to waive or partially fund a reserve this year?
Yes, it's the same statute as it was in the past.
Okay. And Roxana, speak from a best practices standpoint. So legally, the answer is yes from Nicole. From a best practices standpoint, what would you recommend if a client says, gee, I'm not going to fund reserves in 2024?
No, please do not do that. We need to fund. The statute gave us 2 years to try to bring up our reserve levels. And that's what we recommended starting with 2023. Put more into your reserves than what is required by the reserve study. If you have surplus, what we defined earlier, anything in excess of 2 months of operating, put it in your reserves. So more is never bad. And you're trying to catch up with what's coming, because we do believe that the reserve levels, even for those associations that we're doing the right thing, may not be the same. You may have to increase those reserve contributions because there are components that have not been addressed before in reserve studies. So the reserve contribution levels are going to change. They're going to increase.
Okay, thank you. We're at the end of our hour. And just so you know, I have about 45 questions prepared for today. And I'm on question number 8 on my list. So we try to address the questions that are coming in. And I think this is like just terrific. The feedback that y'all have provided for our listeners today is invaluable. I hope they're listening, and I hope that they take the time to re-listen to this, and then you can keep rolling back to the part that I need to hear second and third time to really understand it. So Nicole and Roxana, thank you so much. I'll get back to you. Literally, if we can redo another show next week, maybe Wednesday-ish, I'll put a flyer out for everybody, and hopefully we'll get even more people attending because of the great value that you brought today. So thank you for all of our listeners today. Special thanks to Nicole Johnson-Pendergrass, the Director of Operations at Hafer, and to Roxana Dorigo, Executive Director and Partner with KW Property Management. Nobody does it better than you two ladies. You make budgeting fun. The fun in budgeting. So thank you for that.
Tim.
Thank you, Tim. You're a great moderator. I appreciate all the guests.
All I have to do is sit and listen. I don't really do anything. This is easy. It's the easiest job I have all year. Thank you. But today's session's recorded. You can watch the broadcast again. We'll send out an email to everybody that's registered. Or if you want to go to our website, KWPMC, you can find it there. And we also have a YouTube channel at KWPM TV, where you can find all of our webinars that we do. We look forward to having you join us again, hopefully next week, as we prepare for next week. And then next month on September 20th, we're going to focus on how do you tackle insurance increases and what's the law dealing with insurance. We've got an attorney and an insurance broker that's a specialist. I think everyone's going to want to listen to that one as well. So we're trying to bring value through these best practices webinars. So thank you for joining us. From all of us at KW Property Management Consulting, please be respectful to your neighbors, stay healthy, have a great month. Thank you all. Thanks, Roxana.
Thank you.